This video is on purchase commitments. What is a purchase commitment? A purchase commitment is where a company locks into a contract for some future date. Basically what they try and do is they're trying to purchase inventory at a set price at a future date. There's a lot of different reasons why companies do this. They may be doing it to try and stabilize or solidify their cash flows, right? When they're trying to determine future cash outflows. If you're buying an inventory item that has a market price that fluctuates quite aggressively or quite frequently, sometimes it can be difficult to come up with estimating future cash outflows. So a company will lock into a contract so they can stabilize those future cash outflows, so they know exactly what they're going to be paying in the future. Another reason that a company may lock into a futures contract is that they may fear the price will increase in the future. Right? So if you lock into a contract today for a set price at a future time, effectively what you're trying to do is you're making the assumption that the price will go up, and so that you lock into this futures contract at a price that you're comfortable with, but that is hopefully lower than what the market price will be in the future. Okay, so that's what a purchase commitment is. You've agreed to buy something at a future price or at a future date at a set price. There may be a situation where we've locked ourselves into one of these purchase commitments or this future purchase contract, where we actually have to record a loss at a statement date. There's three criteria that have to be met, and if all three criteria are met, then we need to record a loss. The first criteria is that the contract is not subject to revision or cancellation. Right? And this is just kind of common sense. If you've locked yourself into a contract and the market price is well below that contract price, if you could revise it or cancel it, you'd do just that. You'd get out of that contract to get the market price because it's much lower. So if you're locked into a contract, you can't revise it, you can't get out of it, that's the first criteria. The second criteria is that the loss has to be likely and material. If we've locked into a contract to purchase fuel at $1.27.99, right, and at our year-end date the market price is $1.27.98, relatively no different, even though it's a little bit lower, the loss wouldn't be material, so we're not going to record that. So the loss has to be likely and it has to be material. And then you also have to be able to reasonably estimate the loss, which in most cases you'll be able to do. So if all three of those conditions are met and we've locked ourselves into a contract, then we actually have to do a journal entry on our books to record a loss. Even though the inventory hasn't been delivered yet, imagine our year end is December 31st and we're taking delivery sometime in January. At December 31st, even though we haven't received the inventory yet, we might need to record a loss on this purchase commitment. Let's take a look at an example now and walk all the way through the steps. So we'll look at the journal entries that are required, and we'll look at a whole bunch of different scenarios as to how we deal with this. What we need to understand is, what do we do when we sign the contract? What do we do when when our year-end date comes around? And the final thing is, what do we do when the inventory is finally delivered? So here's our example. This is a practice purchase commitment question. Okay, and just to refresh our memories, there's those three criteria that need to be met for us to need to record a loss on a purchase commitment. Right. So the first is the contract is not subject to a revision or cancellation. The second is that the loss has to be likely and material, and then the third is that you can reasonably estimate the loss. Right. So if you can do all three of those things, you need to record a loss on your purchase commitment. So for the following question, we're going to assume that all three of those criteria have been met. Okay? So we're in a position where we now these three criteria have been met. We now have to decide what to do at those dates that I mentioned. What do we do when we sign the contract? What do we do at our year end? And then what do we do when the inventory is finally delivered? I'm just going to freeze the panes here. Okay, so requirement A says the situation is that we agree to buy 10,000 kilograms of some inventory unit, some raw material. The contract price is $5.70 per kilogram, and the contract date is December 9th. So we've locked into this contract on December 9th. The first requirement asks us to provide any required journal entries on December 9th when the contract is entered into. So do we have to do a journal entry here? Okay, and the answer is no. We haven't received the inventory. Even though we've agreed to purchase at a set price, there is no journal entry when the contract is signed. Okay, so we do not do a journal entry when the contract is signed. If you get this question in homework or on the test, you need to make sure that you actually respond with a no entry required. If you just leave it blank, I will assume you don't know and you won't get marks. Okay, so you have to put NA. There's no journal entry required when the contract is signed. Part B to the question says, provide any required journal entry at the company's year-end, December 31st, assuming the current market price is $5.10 per kilogram. So what we need to decide here is, are we at a disadvantaged position? And if we are, is it significant? And if it is, then we need to record the loss. And if you look, we're purchasing, or we're required under this contract to purchase the material at $5.70 when the current market price is only $5.10. So that's greater than a 10% difference between our contract price and the current market price. So I'm going to assume that that's significant. We are at a disadvantaged position, okay? So we need to record a loss on this contract. Right? So since all three criteria have been met, we have to record the loss. And even though we haven't received the inventory yet, we need to make the journal entry. So that's key. That's one thing I don't want you to forget. At December 31st, we haven't received the inventory yet. So there's no entry here to inventory. So don't try to record anything to inventory at this date. All we're trying to recognize on our statements is the fact that we've got a loss, a likely loss that's significant on a purchase commitment. Okay? So we need to record the loss. We're not recording the inventory. How do I do that? Well, the first thing that I would do is I would figure out what the loss and the difference is, right? We're buying 10,000 kilograms and our contract price is $5.70. We'll take delivery of that sometime in January. Okay? At our year end though, the market price is only $5.10. So there's a 60-cent difference. So what I'm going to do to record the loss is I'm going to record a debit to a loss on purchase commitment, right? For $6,000, and the way I calculate that is to take the contract units, which are 10,000 kilograms, and multiply it by the difference between what I have to pay and what the market rate is. So 10,000 kilograms times 60 cents means that I have a loss on this contract of $6,000, right? So my journal entry to record this is a debit to the loss on purchase commitment, and the credit goes to an accrued liability. So we're going to debit the loss and credit the accrued liability on purchase commitment. And again, that's $6,000. So at year end, even though we haven't taken delivery of the inventory yet, because of the fact that there's a loss that's significant, we can estimate it, and I can't modify my contract, I need to record a loss on this purchase commitment. So I debit a loss and I credit accrued liability. Notice that I didn't impact my inventory yet, right? I'm not receiving this inventory until sometime in January, and it's not until then that I'll actually set up my inventory. Okay? So that's your year-end adjustment. Now let's go to January. Let's go to the next step, which is in January when we actually receive the inventory. Okay, so these next three parts, I've got part C, part D, and part E, right? These next three parts are independent of each other. So we're going to assume that what we did in part A and what we did right here in part B has happened. So we've recorded this loss at year end. These next three situations are independent of each other. So we're going to assume A and B happened, and then we're going to do C. And then we're going to pretend C didn't happen. We're going to do A and B and come back and do part D, etc., etc. Okay? So part C says, assume the situation in B existed at year end. So we recorded that loss on purchase commitment. It says, provide any required journal entry to record receipt of the inventory on January 15th when the market price is $5.10 per kilogram. So now we're actually taking delivery of the inventory. I do this journal entry the same way every single time. Okay? And again, I've mentioned this before, but in accounting, if you can get yourself into the habit of doing journal entries in the same fashion every single time, whether it's the disposition of an asset or in this case recording the receipt of inventory on a purchase commitment, it'll almost become mechanical. And you want to understand the concept, but if you get stuck on a test or if you get stuck in your homework and you've done it so many times that it becomes mechanical, a lot of times you can work through any mind blanks that might occur during a test, okay? So the first thing I do when I take receipt of this inventory is I set up my payable, because I know exactly what that payable is going to be. I've agreed to purchase 10,000 kilograms at $5.70. So I know that I need to set up an accounts payable for $57,000, right? 10,000 kilograms times $5.70 per kilogram. So regardless of what the market price is on the date of delivery, I have a contract that says I've agreed to pay $5.70. So I have to set up a payable for $57,000. Okay? Now that I have a true payable on my books, this accounts payable, what I can do next is I can reverse that accrued liability I set up at the end of the last year. Because now that the real liability is on there, I can get rid of the accrual. So I'll debit accrued liability on purchase commitment for the $6,000 that we posted at the last year end. Okay? So record the AP, debit the accrued liability to clear it out. Okay? And if you think about it, at this point, we haven't set up our inventory yet, so we need to debit inventory. The question is, what do I debit inventory for, right? And you're going to set your inventory up at the lower of cost or market. That was another part to this chapter that you should have reviewed by now, lower of cost or market, right? And we can't, we have to do lower of cost or, and they call it net realizable value, but we have to do these lower of cost or market tests to determine if our inventory is overvalued on our books. So there's no reason, or there's no sense in me setting this inventory up at a value that's too high and then immediately having to devalue it because of my lower of cost or market rules. So when I set up my inventory, I debit inventory at the lower of cost or market. And right now, my cost is $5.70 and my market is $5.10. So which one's lower? Obviously the market is lower at $5.10, right? So I set my inventory up at the 10,000 kilograms times the $5.10 market price. So I'm going to debit inventory for $51,000. Right? Here's where you want to just double check and make sure that your journal entry balances. We've got $57,000 in debits and $57,000 in credits, so nothing else is required. Okay? The reason nothing else was required for Part C is because the market price when we received delivery was the same as the market price. So because there was no difference between market price at year end when we did our accrual and market price when I took delivery, there's no additional loss or a recovery that needs to be recorded. But let's look at situation D now, because it's a little bit different. So situation A and B still occurred. We agreed to a contract on December 9th, and then at December 31st, we did that $6,000 accrual to record a loss on the purchase commitment. So we still did this journal entry right here, okay, when the market price was $5.10. We're now taking delivery at $5.05. Okay, so again, let's go through the steps and let's record the receipt of this inventory. We're now actually getting this inventory, so let's record it. Right? I'm going to go through the same steps. The first thing I did last time was I set up my AP, and I'm going to do that again because I know exactly what it should be. I have a contract for 10,000 kilograms at $5.70 per kilogram, so I'm going to credit my accounts payable for $57,000. Right? The second thing that I did in the last example was that I reversed the accrued liability on my purchase commitment. Right? We set up an accrual for $6,000 at the end of the last year. I've now got my true payable on my books, which is $57,000, so I don't need the accrued liability anymore. So to get rid of it, I'm just going to debit it. So I'll debit the accrued liability on purchase commitment. Okay? Next, what I want to do, and I haven't done yet, is I want to set up that inventory, right? And again, I'm going to set my inventory up at the lower of cost or market. So our cost right now is $5.70, and the market is $5.05. So again, which one of those is lower? Obviously, it's the market at $5.05. So when I debit my inventory, I'm going to debit inventory for 10,000 kilograms times $5.05, which means I'm going to debit my inventory for $50,500. All right? This is the point at which you want to check and see if your journal entry is balanced. Okay? And I've got $56,500 in debits and $57,000 in credits, which means I need to balance this. I need a $500 debit, which is going to be a debit to an additional loss on that purchase commitment. If you think about it, We did an accrual at December 31st, and we recorded a loss at $5.10. Since that time, the market price has dropped 5 cents down to 5.05. So that additional 5-cent drop is another loss that I have to recognize. And 5 cents times 10,000 kilograms is equal to $500. Okay, so I have to recognize the additional loss from the time that I accrued it at year end to the delivery date. And if that gets too confusing for you and you can't understand that theory, that's okay. Just make it mechanical. Credit AP first, reverse out the accrued liability, set up the inventory at the lower of cost or market, and then if there's a difference, if it's a debit, it's a loss, and if it's a credit, it's a recovery. Okay? So let's go look at part E, which is going to be the last situation, which is where we're going to see some type of recovery. Because we've locked into a contract at 570. At year end, the market price was 510, and we recorded an accrued loss, right? We're now in situation E, where we're assuming that we've taken delivery on January 15th, and the market price is 585. So there's been a significant recovery from year end. The market price has actually recovered above what we're paying, so we're in a good position here, right? Conservatism won't allow us to record a gain on this contract, but we can recover previous losses that we've recorded. So again, if the theory is a little bit too much for you right now, just make it mechanical. Let's go through the recording our receipt of inventory step by step. Again, the first thing that I'm going to do is I'm going to record my accounts payable. I know exactly what I have to pay. I've agreed to pay for 10,000 kilograms at $5.70 per kilogram. So I'm going to credit AP for $57,000. Same way I did in the first two entries. The second thing that I'm going to do is I'm going to get rid of that accrued liability I recorded at December 31st. I set up a $6,000 accrued liability. Now that I have my real payable on my books, I don't need that accrued liability anymore, so let's get rid of it. So we debit accrued liability for $6,000. Okay, the third step is to record your inventory. And again, inventory is recorded at the lower of cost or market. In this situation though, cost is 570, market is 585. Now our cost is the lower of cost or market. So when I set up my inventory, I'm going to debit inventory for 10,000 kilograms at the lower of cost or market, which is 570. So I'm going to debit my inventory for $57,000, right? And here again is where we check. Do we have a balanced entry? I've got $63,000 in debits, right? And I've got $57,000 in credits. So to balance this out, I need to record a $6,000 credit. What is that credit? It's a recovery of the loss on purchase commitment. Okay, so that's all there is to a purchase commitment. You have to understand that at the date of signing the contract, we're not going to do any entries to record the contract. At year end, if those three criteria are met, you may have to do an adjusting entry to record a loss, right? And then when you take receipt of the inventory, make it a step-by-step process. Record your AP, reverse the accrual, set up inventory at LCM, right, lower of cost or market, and then plug the difference. If it's a debit, it's an additional loss. If it's a credit, it's a recovery. One thing to keep in mind though, because of LCM rules, this debit to inventory will never be greater than the contract price. That 570 in this example is the absolute highest we can debit inventory for, because lower of cost or market rules will cap out there. So even in this last example, when market price was 585, we couldn't set it up at 585 because the lower of cost or market was the contract price of 570. And that's it for purchase commitments.